Good morning and welcome to Coffee with Tom and Joanne. I'm Tom Matthews.
And I'm Joanne Taranto. Thanks for joining us. We have a great topic today, and we are talking about down payments on multifamily properties. So today's conversation is going to be specific to multifamily properties that are between 1 and 4 units. And the reason that we're going to make that specification is because once you get to 5 units and higher, the financing terms then become commercial and it's a whole other ballgame.
Yes.
So for today, we're just going to talk about the average multifamily, which is 4 units or less, and what kind of down payments you need to get one of those properties. So Tom, why don't we start with why don't you talk about an owner-occupied multifamily? So somebody who wants to buy a multifamily property that they're going to live in.
Absolutely, Joanne. And I think this is one of the greatest ways to start to build wealth is to buy an owner-occupied 1 to 4 unit property. Because if you're a U.S. veteran, you can buy it with 0% down using the VA loan. If you're just an average American, you can do a 3.5% down, and you can get the seller to pay up to 3 points of your closing costs. And if you don't want to do FHA, you can do conventional financing and do 5% down. You oftentimes hear people say you have to have 20% down to buy a property, but that's just not the case. I think National Association of Realtors said in 2022, the average down payment across the board was 7%. So what's great about a multifamily property is you have the opportunity to buy this property, get into home ownership, and then you have anywhere from 1 to 3 other units that are helping you to pay your mortgage. And every month you're paying down that mortgage and you're building equity.
Right.
So it's a really great opportunity. But Joanne, what about if you decide you want to buy a single family first and then down the road want to buy an investment property, 1 to 4 family? What does the down payment look like then?
So the down payment when you are not going to owner occupy the property is a little bit different. And the reason is risk involved for the bank. They want to make sure that they have a solid footing of equity before they lend on the property that they know you're going to be renting out to others. So generally speaking, you need 25 to 30% to put down on a multifamily property, and that will depend a little bit on what your situation is financially and so forth. But it's significantly more. So you can see how buying into a multifamily after you are already settled in a primary residence is a little bit more challenging. And, the flip side of it is if you buy the multifamily first, there are some concessions you have to make on lifestyle. You're sharing a building, you have shared walls potentially, you're sharing parking and a yard. So there are some considerations to be made. And I can remember buying my first multifamily and seeing all of my friends moving into these single family homes and then just kind of spreading their wings and having all this space to themselves and being able to walk out in their backyard in their underwear or whatever they want to do. And it was a little bit of a hardship for us because we were still apartment living straight up through having our first child. So while I'm really, really grateful that I have that multifamily that I still own, we did get into it with less than 25% down. But now buying future properties, we need to have 25% down to buy more, which is, for a lot of people, and especially in our geography of the Northeast, it's a significant amount of money. So what do you do if you don't have 25% to put down on a property around here? Tom, do people invest in multifamilies away from where they live?
Absolutely, Joanne. And it's a little bit more challenging, but people buy in other states all the time. And, what you want to do is look for demographics and check out state rules around tenancy and so forth. One state that pops up a lot is Missouri. A lot of people own there. It has pretty landlord-friendly laws and so forth. It, again, will come down to what your comfort level is. And are you okay with having to share some of your profit margin by paying a management company?
Right.
Because there are some people that just want to do everything themselves. And for those people, you have to look local.
Mhm.
And I still think, we're based in Concord, Massachusetts, so prices are high. I still think there are opportunities in Massachusetts to buy multifamilies at, what I would call more reasonable pricing. Now, the
Mhm.
rents are going to be kind of lesser, but as long as the numbers work and the capitalization rates there, and we can talk about that on a subsequent video, you can still make it work. But there are markets like Fitchburg, Leominster, Gardner, Worcester, Holyfield, Holyoke. I'm sorry, Holyfield's a boxer. uh, Springfield. There are markets you can go to where they're urban, where the price point, the barrier to entry is lower. That gives you that opportunity where you don't have to leave state lines. But
Right.
it's just important to kind of know the options and to understand how to run the numbers. I used to watch a YouTube video a lot called One Rental at a Time, and all they talk about, all that matters, doesn't matter what the interest rates are, doesn't matter what anything is, only thing that matters is the capitalization rate. Do the numbers work? Do you have positive cash flow at the end of the day?
Right.
And that, because sometimes, particularly for us, when we work with homeowners buying a single family home, they're so rate sensitive. They're so focused on the monthly payment. And sometimes when you're trying to transition from owning a single family home to buying an investment property, you're still stuck in that mindset of rate sensitivity and cost. And
Mhm.
now you're buying an investment, which is a business, and you have to be worried about net cash flow, not necessarily just the cost. Right?
Yeah.
Can you speak to that?
Yeah, absolutely. I mean, and especially if you're going to go into this as your primary residence, you don't have to live there forever. You just have to move into it as your primary residence. And so, what a lot of people will do, especially young people that don't have families and a ton of pets and other responsibilities, they'll go in, they'll buy a multifamily, they'll live in one of the apartments, they'll save and repair whatever they need to make that house kind of self sufficient. And then once they have, the even as 3 to 5% to put down on the next property, they move forward and purchase another one and then move into that one as a primary residence. Now, there's also a key difference between the interest rate when you buy as your primary residence or you buy as an investor. As an investor, you're going to pay a little bit higher interest rate. As a primary owner, you have the lowest interest rate that's available, throughout the market. So there's a definite advantage for moving into the multifamily to get it established and moving. So they call that a little bit like house hacking. You move into a multifamily, you get it get it stabilized, repaired, save for the next down payment, move to the next multifamily.
I think generally you have to stay there for 2 years in order to make it a new primary residence, but you'd have to check in with your loan officer on that. We're just giving kind of high level overviews of what we've read about, seen clients do, and whatnot. But
Yep.
that's a great option too. I started selling real estate, Joanne, as everyone knows, when I was 23 and didn't have that steady income. And one I wish I could have had. I started in college at a job and had steady income, so I could have bought that multifamily when I was young. But now being 44 and doing this for 21 years, I'm super excited to be buying investment real estate. And I think there's so many tremendous opportunities to generate wealth and build legacy for our families.
Right, and diversification of your financial portfolio, not
Right.
putting all of your eggs in one basket.
Right. Right. Not just having the 401k. You got to have different lines of wealth opportunities, right?
Right.
And that's what we want to educate people who are in our sphere of influence of what are ways you can generate wealth and kind of improve your life, and how can you leverage and understanding where to be in coming up with capital for doing a down payment like this is really important for clients.
All right. Well, thank you for joining us today. This was a great discussion, Tom. And if you have more questions, we're always here to help you work through your personal scenarios. But we appreciate you listening. And I'm Joanne Taranto.
And I'm Tom Matthews. Cheers.
Cheers.